All right, hey guys, I have a pretty good conversation for you today. It's with Graham Rowan and Nick Rathall from the Inside Investor Club in the UK. They have a really interesting model, and the reason I wanted to talk to them is actually because I think that they are part of a trend that we're seeing grow more and more, and I think is going to continue to grow, and that is kind of taking private market stuff and connecting it with a publishing model. So that they are an investor club focused on high net worth investors who invest in private equity deals, right? So they're filling a niche in the private equity market that's kind of maybe like the smaller to mid-sized stuff, earlier stage, but they are filling it and they're raising money directly for companies. Now, this is not something that everybody can do. There's a lot of different regulatory environments, and like I said, they're in the UK, which has different rules in the US. We see this with Catoosa Research doing some similar things in a different way up in Canada. But it is an interesting intersection, right? Where we're seeing a lot of the specifically private market stuff, but not just private market stuff. Um, like merging with media and publishing models where people are investing directly. This direct to investor model is, to me, one of the biggest trends that we're seeing kind of pop up in every form that it can all over the place. And there's a bunch of stuff that we're going to be announcing soon around FMS and kind of some transformations that are happening in my business, and how I think we can serve our industry better soon. But that's coming up. But for now, I'd love to kind of listen to this conversation. I asked them to talk more about the investing side a little bit up front too, so you kind of understand what they're doing and kind of explain like their conversations with the companies that they're raising, so you can get kind of a more of a sense of the behind the behind the scenes stuff around their model. But it is an interesting one, and I think you'll find it interesting. I've known Nick for 20 years, and they're doing some cool stuff. So check it out. I think you'll find it interesting. All right, hey everyone. I'm here today with both Graham Rowan, who's the CEO of Inside Investor Club, and Nick Rathwall. I'm sorry, Nick, I said your name wrong. Nick Rathall,
Yeah.
Director of Business Development. Welcome, guys. Thanks for being here.
Thanks,
A
John.
pleasure.
Great to be
Thanks.
here.
Thank you for inviting us.
Yeah. So, Nick, I've known you for 20 years.
Yeah,
We go way back to Clayton Makepeace's conference where I
that's
entered the
right.
business.
Yes.
Um, and it's been so great to see your career kind of evolve here. And Graham, you have quite the interesting background here. So what we're going to be doing today is talking about the Inside Investor Club. But I mean, you've written a book, Diary of a High Net Worth Investor. You've had three TV series on Sky TV. Is that right? Like Make Your Money Work, Finding Financial Freedom, Money and Me. You've also spoken at a variety of places, including working with what is it, Buford Private Equity, where you
Beaufort,
were,
yeah, yeah,
yeah.
yeah.
So educating basically hundreds of high net worth investors about private equity investing, correct?
Yeah, that's right. It's I mean the background really is that I came originally from a corporate background. I was a director of
Mhm.
Texas Instruments that many of your viewers will know. And I had a professional wealth manager who put all my money into the Nasdaq and then left it in there when it crashed and burned at the beginning of the 2001. And then they said that the losses meant that my net worth was below the level at which they looked after clients, so they would have to let me go. So I got fired by my own wealth manager for the losses they made in my account. And that was the start of my journey to taking personal control of my financial future. And eventually that led me into making lots of investments, some of which worked, some of which didn't. And really, because of the losses they'd made, I was kind of behind the ball. I was already in my mid 40s. I was not where I needed to be. So I kept looking for how I could play catch up to find something that would give me good above average returns. Because, if you look at something like the S&P 500, it averages just over 7% a year net of inflation, which is great if you've compounded that across 3 or 4 decades. But if you're in the position I was in, that wasn't going to be enough. So eventually that's what I guess lured me towards direct private equity, where you can get 3x, 5x, 10x returns in a relatively short period of time. So having kind of found that solution myself, friends and family and so on just kept asking me what you're doing. And that eventually led me to forming, investment clubs where I could help them to do the same thing. And that's really the current mutation of that, if you like, is Inside Investor Club that you mentioned.
Interesting. So, um, private equity is a broad term, right? It means, lots of things. Um, when you're talking about private equity investments, what's kind of the range of opportunities that you are bringing to people right now?
Yeah, the first thing to say, I guess, is that we're not a fund. We're not like these big BlackRock or KKR or anything like that. We are looking at direct investing into growing but relatively young companies. So I have a whole bunch of criteria I look at. Um, I certainly want them to be solving a real problem in the real world, ideally with some unique technology or intellectual property that can be protected. So, for example, through patents. I'm looking for the size of the addressable market to see if they've got the potential to be, if not a unicorn, at least to be 10x bigger than they are today. I'm looking for the quality and background of the founders. And I'm looking for some decent skin in the game from the founders so that they're going to really be focused on making this particular business work. So typically we would probably come into firms that have an enterprise value of anything from 20 to maybe 80 million. We'd be looking to do anything from 500,000 to a 2 million raise at those kind of values. It's not actually uncommon for us to do several raises at different enterprise values across a 2 or 3 year period. As the company grows, the story gets better, people are prepared to come in at a higher value. So typically we're looking for something that would 5 to 10x in a period of anything from 3 to 7 years. And I also try and get some clarity on the exit because every pitch deck you read says it's going to sell, it's going to be a trade sale or an IPO. Well, I want to dig a bit deeper than that. Have they
Mm,
already got a target in mind? Because these days, fewer and fewer companies use IPO for the exit. There's usually either a trade sale or perhaps a sale to a private equity fund. So I want to see how switched on the founders are to that because some of them, the really cool ones, they're grooming the business for only
mm.
2 or 3 potential buyers, even from when they very first begin, because they can see if they build it to this level, it'll be such a perfect strategic acquisition for that company.
Yeah, that makes perfect sense. There's two thoughts that I have on that, related to what we've seen in the publishing space and other sides. Is that one, you have the founders who understand the business of the business, and then you have the founders who also understand the business of the money. And that once you start getting into the world of like looking at a business as an investable asset, the knowledge of the business of the money side of the business is critical, in that even great businesses otherwise are ruined because the founder didn't understand the financing side and kind of what the opportunities were. um, and then the other part of that is that in the publishing space, we've seen, especially on the kind of the crowdfunding product side, places where people were trying to invest in private deals, um, that the issue of the lack of liquidity for subscribers has been a real problem for folks. The fact that things, a lot of times things were not going to have an exit, that even in kind of a more of a venture capital kind of product model, like that most of those companies aren't going to work, um, especially if they're just scraped off of crowdfunding platforms. And so a lot of the money kind of became dead money because there was no exit plan, and the analysts weren't really looking at what had a real exit plan. And so that became a real problem in the business for a lot of reasons, but most fundamentally because it ended up not being good for the customer.
Yeah, I think there's two points to pick up on there, I think. And that the first one is very definitely part of the evaluation of the founders is, as I say, they're not just a bunch of tech head students who had a great idea. I look for a bit of maturity and people who've been around the block a few times. But also, what we find is that we at Inside Investor Club often end up having to help them to tell their story in investor
Yes.
speak. They can talk all day about their technology, but they can't
Mhm.
talk about, how they're going to increase enterprise value, how we're going to get to these milestones, where the exit's going to come from, what's plan B if that exit doesn't work out. So we end up really holding their toes to the fire on those things so that we can actually strengthen the story and go out
Mhm.
to our investors. Because, I have a bunch of about 200 high net worth families who are in the club, and, they are gray haired, a little bit cynical, been around the block, had the kind of problems you've talked about. So, you can't pull the wool over their eyes. You've got to be clear that, this is how we believe it's going to work. This is the proposed exit strategy. But the other thing I would say is we're very definitely not the kind of venture capital spray and pray, let's invest in 100 in the hope that 5 or 6 will work approach. I very much take the Warren Buffett approach that he has in the public markets and apply that in the private markets. I only want people to make 4 or 5 decisions in their portfolio. And to be clear, we have a kind of model portfolio we share with our members where private equity would be maybe 20 to 25% of it. We're not saying put all the chips on red. You know, we're looking at, yes, have some of the public stock markets, have some dividend paying shares, have some rental real estate, have some Bitcoin, have some gold, definitely keen on that. But for that 20, 25% of your portfolio, you know, that's where you're going to move the dial. And I just published a white paper that I'll send across to you after the call, where one of the things I point out is there's this artificial wealth effect. I called it, I'm a millionaire, so why do I feel poor? And it's all about the fact that really, if you look at real estate, the S&P 500, all they've actually done in recent years is keep pace with the increase in the money supply. So, you know, if in a fiat currency world, if you double the amount of dollars in existence and there's still the same number of shares or houses, all you've done is double the number of dollars you need to buy that amount of house or share. You haven't actually got wealthier. So whilst it's way better than holding it in cash, because at least you've kept pace with a combination of inflation and currency debasing, to make real progress and move the dial, you need something like private equity that can go way above and beyond that. Otherwise, frankly, you're just marking time. And a great way of doing that, you know, is to compare the Dow Jones to the price of gold. And you'll see that today we're exactly where we were just before the Wall Street crash of 1929, you know, so you get a very different perspective on where either your home or your net, you know, your investment portfolio is at when you come out of the fiat world and compare it to something real like the price of gold.
Yeah. So let's step back then and talk about the Inside Investor Club as a publishing platform. Um, so it seems to me that, like, if I understand it correctly, then you have there's a membership and then you have coaching, but the membership is the core business, and that you have in that membership, like you said, you have your model portfolio and you're bringing unique deals. Um, the tone and everything of the business seems to me, and the goal of acquiring customers is that kind of high net worth, like you said, family, high net worth investor, not somebody who is kind of your traditional, I wouldn't say traditional, but not just a common retail investor. You're looking for somebody who is probably more successful in their career, maybe has obviously built some wealth, because in order to be able to put 20% of your portfolio into a deal like that, where you're looking at maybe a $50,000 to $100,000 investment, this is not somebody who has $20,000 or $100,000 in their
Yeah, no, absolutely. And we are constrained by regulation. So we can only deal with accredited or high net worth investors. Obviously, the rules for that specifically vary from country to country, but it's quite a low bar in the UK. It's an income of 100,000 a year or a quarter of a million investable assets. I know it's a bit higher than that in the States. But yeah, we just want to deal with people who are comfortable with this kind of investment where it's not going to make them lose sleep at night. You know, to be frank, we found that the people at the lower end are often the ones that are the hardest, the highest maintenance, if you like. So yeah, we only want to deal with people who are accredited, and within that, we only want to, you know, talk about 20%, 25% of their portfolio. So typically, we'd be looking at somebody with a, you know, a low 7-figure net worth, something like that. Usually, they've been an entrepreneur or a big real estate investor, something like that. And you know, certainly in the UK, there are even tax breaks when you move from real estate into some of these smaller companies, because the government's trying to encourage this sort of investment to get growth in the economy. So yeah, the starting point is very definitely, we're not at the biz op end of the market, or the, you know, perhaps some of the trading platforms where they come in with a low initial stake and try to build it. We're looking for people who've already achieved something like that success, so, you know, low 7-figure net worth upwards, and that's where we find our sweet spot.
And so what's the customer experience like when they join the club? Like, what is it that they get? What do you do? Because it seems like you seem to have some events that you do as well. So what's that look like from a customer experience?
I think what makes us pretty unique, I think, is that we combine the kind of coaching and mentoring that we think is needed to make somebody a confident private equity investor with the access to a small number of these opportunities where we've done all the hard work on due diligence. Now, we can't give financial or investment advice, so we always have to leave it to the individual member to make a decision. But what we're trying to do is empower them to make those kind of decisions through having had some training and coaching. We also do quite regular market updates. We have a twice weekly newsletter that keeps them up to speed, not just with our own content, but with all other stuff around there, what's happening in the world, wider in the wider world. And then, yeah, we have online events and we have live events because one of the things you find is that people really value meeting and networking with like-minded folks because there's so few
Mhm.
places you do that. And if you are into this kind of investing, the chances are most of your own friends and family are not. We always find
Mhm.
we're fishing in a small pool here. It's like 3% of the population that seems to
Mhm.
care about their financial future more than their next iPhone or their next holiday. So when you can get 100, 150 people of these people in the same room, it's frankly for me as the kind of master of ceremonies, it's quite hard to keep them under control because they want to talk to each other so much. So it's a combination of it's printed information, it's emails, it's live updates online. We do a monthly Zoom call where people can ask me anything about wealth creation or wealth protection. And if I can't answer it, I'll get them in touch with someone who can. And then there's the whole kind of investment portfolio side. So it's really, we do try to create this sense of community. We are quite exclusive, as I say, less than 200 members at the moment, but we have some members in America already. We're seeing a lot of interest from America. And also, obviously, we're seeing lots of private equity things happening there. The next couple of raises that I'm doing are for companies who are already strong in places like Singapore, India, the UK, but are also going to migrate into America because they can see the opportunities there. So, I would think if we were having this conversation in a couple of years' time, we'll probably have as many members in America as we do in Europe.
Very interesting. That's very interesting. The I like this approach that is a little bit more comprehensive, right? It's not the like here's a trading strategy or here's trades. It's a more comprehensive look at wealth building for somebody. It kind of reminds me a little bit of the not exactly obviously, but the Tiger 21 model where
Mm.
they have high net worth and it's basically like you get together with peer groups to kind of look at like what you're doing with your money to make sure that you're not ruining your portfolio. And that I think it's a very attractive piece that you have for that higher net worth person because like you said the traditionally what they have are they have their wealth advisors who a lot of whom are really just asset gatherers, they're salesmen. um, and so having that peer group and having the expertise to kind of say let's look at this a little bit more comprehensively, but you're not so you have a more model portfolio. I'm assuming then that you're talking about some of the larger trends in kind of the general markets at any given time. I think there's something going on with tariffs. I'm not sure right now.
Oh,
Um,
wow. Yeah, I tell you, I
uh,
mean, I don't know about you, but certainly for any of us who've been around the block a few times, I think the 2020s are turning into one of the most challenging decades. I think I would perhaps compare the 1970s to it, but
mm,
I just had access to some research, which isn't going to be officially published until July. So I'll share a couple of things from it with you. Um, this is all about, this massive wealth transfer that has just about started between
mhm,
my kind of baby boomer generation and then the Gen X and the millennials. I mean, it's around about $80 trillion is going to change hands. And there's a survey done of the family offices where this is happening. And 81% of those next generation inheritors are saying they're going to change their wealth management company because they don't like the job being done by the one their parents are using.
mhm,
And 51% of them are saying the biggest thing that's missing is access to direct private equity. So I think we're seeing a generational shift between the patriarchs who kind of went for,
mhm,
I guess, for real estate and bonds and all that kind of more conservative stuff. the next generation are saying, hold on, there's all these other opportunities that we're not even getting access to from our conventional wealth management companies. So I'm kind of thinking, well, that's very much the space we're in. So maybe the opportunity is there to partner with some of these organizations to fill a gap that they clearly are not providing at the moment that could
Mhm.
cost them a lot of business as those kind of wealth transfers start to really take off in the coming years.
Yeah, that's very interesting. I think that we've seen that definitely over the last, I guess, 12 to 15 years, that I mean, so much money has moved out of the public market into the private markets. And there's, kind of the sense that the public markets have almost become kind of a mutual fund, in that it's just everything tracks, and that a lot of the alpha is in the private markets. And like to your point earlier, like fewer and fewer companies are using an IPO as their kind of exit strategy, or even part of their path. And then you kind of add to that there's so much restrictions on who can invest. And we've seen things like in the US with like the rise of the crowdfunding market, and I know this will, in the Reg A market and raises, but and obviously this week we had a big, I think it was Newsmax, they had a Reg A earlier on that people were able to invest in, and they had a very large IPO. But it's very rare for really successful companies to offer any type of investor participation to retail investors in any way at this point, and they stay private longer. And most of the exits, like you say, are to other companies, and so it's definitely an area that's grown across the board. And from a publishing standpoint, we've seen a shrinking of the number of stocks over the last 25 years, and that means the number of opportunities to choose, and how much interest has moved towards that private markets. And one of the messaging things that I see, and I'm seeing it this week and very much, is that one of the kind of sales points that I see the salesmen the bankers and stuff using these days is, oh, look, the market's in free fall, but the value of these private deals hasn't changed. And so it's being positioned correctly, and in some cases incorrectly, as a is being disconnected from the market as a whole, and so it's not as volatile. Now there's different issues, obviously, besides that, but it is an interesting dynamic to see the conversation go in that direction, where it's like, public markets are very tricky, especially in times like this. Private markets offer some stability to the value of the investment that we're not seeing in a more volatile market.
Yeah, well, I think this is definitely a true of private equity because it's not mark to market in a kind of real-time basis the way the
Mm-hmm.
S&P 500 is. It means you can sleep at night when it goes through a period like this. Now, obviously, it doesn't mean that they're completely isolated from economic developments and economic reality, but they do have control over when there's going to be a capital event. So, they will only issue more shares if they need more money.
Mm-hmm.
And they would time any exit for a good period in the market. So we shan't know the impacts of all these tariffs for at least a couple of years. So we've got time to sit back, see how that's going to evolve. Of course, there'll be winners and losers, and I think some of them will be quite unexpected, if you like, in terms of the way
Mm-hmm.
things will be tweaking around. So this is a good time to not be in the public market from a volatility perspective. And
Right.
yes, obviously, at some point, you will become relevant to that if you're going to IPO. But even if you're just going to sell to another private equity company, you're not going to find that problem. And there has been a view, because some of the private equity funds have been trading at a discount to their net asset value. So there's been a kind of a rumor that they were overvalued, and that if they did actually come to market, they'd be a lot lower. Well, that hasn't actually been the case. Where the big funds have been exiting companies, it's been at or above the net asset value on which they were being held on the balance sheet. So that's one point to bear in mind. The other thing to bear in mind about the wider private equity sector is that the fastest growing area now is what they call secondary funds, where you perhaps invested in a company early doors. It's now gone in for 2 or 3 years, and then there's a possibility. For example, a platform in London called JP Jenkins, where you can go on there and buy private equity shares from the original owner, if you like. And that
Yeah.
means they can get liquidity, but but at a higher price than they originally paid. You come in kind of halfway through the journey, so they might be going to an IPO or a trade sale, and you effectively pay more than you would have done, but you also save 3 or 4 years of time. So those
Right.
secondary markets are going to become bigger and bigger, I think. And there are secondary funds out there now that specialize in acquiring companies that are, effectively second-hand, as it were. They've gone through 2 or 3 years of growth.
Mhm.
So that will also, I think, start to address the liquidity issue as we go forward, because there'll be people that want to sell and there'll be people that want to buy into a story. So if, for example, you look at something like SpaceX, that's a privately held company. Now it's now worth, I don't know how many billions, but imagine
Mhm.
if you'd been able to get into that when it was worth 50 or 100 million and
Mhm.
go on that journey into the mega billions, you'd see a tremendous return from that company. So some of those shares they do a secondary sale every 6 months, I think. So you're getting into companies like that on the private secondary markets as a whole new emerging
Mhm.
sector as well.
Yeah, that is an exciting area, and I think I'd be curious to know too. Since you're not a fund here, and you're bringing individual investors and you're doing these raises, what's the kind of company perspective on working with 100 or more retail investors, high net worth, um, to raise money? Like, what kind of conversations are you hearing from them? Obviously, they're interested in it if they're doing the deals with you. How do they kind of view this versus going to a traditional fund? I mean, I'm assuming they're doing that as well, and this is just another kind of tranche of raise for them. Um,
Uh, yeah, I think the attraction to our investment partners, if you like, is that we are not acting like a VC fund where we're going to try and take control or have voting rights above and beyond our shareholding. We are enablers, but we're not controllers. So they're quite like that. Sometimes they're perhaps too small for the private equity funds, but perhaps too big for the pure VCs. So we're kind of in the middle of that kind of tier. But yeah, mostly the founders are looking for the investment and a little bit of support. Sometimes I get asked to join their advisory board and things like that, but they don't want to cede control. Most of them actually like the idea of increasing the spread of their cap table. They've often just got founders, friends, and family on there. We are often the first to come in after that stage and before any institution. So one of the things, again, back to the liquidity point, one of the things that we sometimes look for is at what point they'll be ready for an institution, because that
mhm.
can be an exit for us. So, for example, in fact, I'm waiting to hear, hopefully today, about an exit from a Swiss-based company that we got into that's in the aerospace and defense sectors, which, as you can imagine, are very hot at the moment. Um,
Yes.
and our investors are potentially going to get, I think it's going to be an 8.8x exit in 3 years from that fund. So, and that's because an institution is coming in to take, I don't know, 20% of the company, and they want to clean up the cap table and take out the early investors. So
Mhm.
some of the companies we talk to would prefer it if we came in as a single entity, an SPV company, something like that. Most of them are actually okay with taking in a bunch of investors. Typically, it's only about 20 or 30 people that would come in on a given round that we do. So it's not
Mhm.
hundreds.
Right.
But as we get bigger, that may also become more relevant. We might look at perhaps co-investing through an entity like an SPV. If we were doing a 5 or 10 million raise, our
Mhm.
direction of travel is upwards. When we first started, we were typically averaging a 20K clip size per investor. It's now more like 80K. And as that gets up towards 250,000, 500,000, then I think we may well look at some kind of structure to invest through. But at the moment, it's just direct investing. Each person becomes a direct owner of shares in the target company.
Mhm.
And both the company and the investors are very happy with that direct relationship.
Right. So then, obviously, that's actually my next question was related to you. You've been doing this for long enough then to be seeing exits on these deals. What kind of experiences have you had with those kind of exits then?
Yeah, we've seen a mixture. We've seen exits on the when an institution comes in. We've seen exits on a secondary platform. We're seeing things like Middle East sovereign wealth funds wanting to come into some of these technology companies as they grow. But we've also, to be fair, we've seen delays. We've seen things where they were hoping to do it. Obviously, COVID got in the middle of a lot of things for many
Mhm.
companies. Um, And also, there's always this trade-off between timing and value. You know, if you're just a few months away from some big contract wins that are going to have a major impact on the value, founders tend to be reluctant to press ahead and sell too soon. You know, so there's always this
Right.
element of negotiation and timing. But yeah, the for example, we've just finished a raise for a company that's dealing with the whole area of digital inheritance. You know, we all own so many more
Hmm.
digital assets like crypto, but even things like, you know, your medical records. I've got 8 pages of A4 of usernames and passwords. You know, my wife goes crazy.
Yeah.
What happens to it? How am I going to cope if you get run over by a bus? So they've built a platform where you store all these things, and you have your trustees who control the handover, and your beneficiaries, your children or charities, whatever. And that kind of platform is raised there. So we've done a raise now. And then the founders are saying that in about 6 months' time, we got in at 20 million. They want to do a partial exit at 50 million. So there'll be a further chance there for us to come out in a few months with a 2.5 times uplift, or indeed to reinvest again if we can see, because we can see a route to a 250 value in a couple of years' time. So where we can try and engineer those kinds of what I call mini exits, we do that as well, and we can, you know, get a win-win where those who want a quick turnaround and are happy to take 2x now rather than 10x later, we try and accommodate that as well. So it's all kind of gets built into whatever the founders are looking to do as well, because clearly they're going to drive it as majority shareholders. But if we can engineer either a secondary, a partial exit, or an institution, then we try and work to give that liquidity to our members.
That's great. Then are you seeing, um, so like from a kind of American publisher standpoint, it's interesting to me that you have you're an access point to the European private markets, at a time when it would seem that, like you mentioned, the defense company, that there was a lot of investment starting to happen, like an increase in the volume of investment potentially quite a bit across Europe, with just the nature of the geopolitical situations and the way the world's changing. And so that's an interest. There's a lot of, like, I mean, you know, we've seen the DAX go straight up this year, basically, and so it's it's really interesting to me that you were a channel for anyone who's interested to kind of get into that market on the private side through a publishing model, um, and the opportunity to then work with you guys, either as an affiliate or maybe perhaps more closely aligned. I know you're very open and interested in kind of exploring partnerships with different types of groups here in the US. Obviously, there's wealth managers and things like that, and there's all the publishing world that we have here. What kind of like what kind of alliances or partnerships are you looking to explore, I guess?
Yeah, I think, yeah, ideally, anyone who's got access to a database of accredited investors who are interested in investing, the fact that they are subscribing to a publication such as the kind of ones that your ecosystem includes, would mean that they are above average interest in investment opportunities. So yeah, I think there could be a very significant synergy there, both for accessing Europe and also, you know, places like India and Singapore, where we also have quite strong links. So there's a lot of stuff going on, you know, outside of what's already happening in America, that I think they would perhaps want some exposure to.
Hmm.
And because we have the combination of, you know, being involved in content creation and being involved in actually finding the investment opportunities, then I think a tie-up with some kind of publisher who wanted a more specialized publication, you know, a direct, even a direct equity, private equity newsletter of some kind,
Hmm.
where maybe it's kind of a new opportunity to reuse existing contacts that they have in their database, but to make a new kind of offer to them
Hmm.
into something that perhaps they hadn't considered before. I think it could be quite credible, and therefore, yeah, be more than open to a conversation. We do charge a fee for people joining the club, and we'd be
Of
more than
course.
happy to share that with
Hmm.
whoever could provide us with access to those kind of people.
And are the events a deliverable, a membership benefit then, or are they sold separately, or how do you work that piece?
Well, if it's an online event, then yes. So for example, we have 30 hours of video in our Kajabi platform where, anyone that joins gets access to that. So immediately in their own time, they can start learning about the whole private equity sector and where we fit in that. They obviously get access to the newsletter that comes twice a week. They get access to the monthly calls. In terms of live events, be more than happy to look at holding any if they wanted to. If they could get a critical mass together, we can do it in America. If they would like to send some people to our European events, then again, more than happy to discuss that. I actually live in Portugal. I suppose, what you call a tax exile from high tax UK. Nick still has the misfortune of being out there at the moment, but he
For the
likes.
time being.
Yeah, you just like paying a lot of tax, don't you, Nick? So yeah, we would be more than happy to talk about, inviting people. I think Lisbon would be a great place for events, obviously
Hmm.
London. But equally, if it's New York or California, whatever, wherever there's a critical mass, I think there's so much benefit from getting people in the
Hmm.
same room. I've seen
I
some of the
agree.
events you run, John, and it's clear that people so value being able to get together face to face, as well as whatever the content is that you
Hmm.
deliver. The networking is priceless.
Yeah, and I do think that the kind of community event piece is something that's going to be increasingly attractive to people, um, just as the overwhelm with online content and AI is speeding it up. Uh, and so I think the in-person stuff is definitely interesting, and I think that obviously in the US, like the one of the things on the investment side that we've seen as a persistent trend has been that a travel related piece for people is always attractive. I mean, frankly, just it's always attractive. Like it's here's a reason to go to Lisbon for like investment related things. Like it's a nice setup, and it was one of those things that I put in one of my state of input presentations a couple of years ago. Was that one of the only areas of overlap from kind of the boomer generation and the millennial generation when it comes to how they spend money is both spend money on travel, um, at a very high rate compared to other groups or other generations. And it was always interesting to me that we've seen that with like conferences like the Money Show adding investment cruises and things like that, that there's a real appetite, I think, out there for, especially in the higher net worth side of the market, for traveling to an event for something that's interesting to meet people in person and do it in a great location that they would go to regardless if they had a reason to, just because they like the vacation. So
Yeah, well,
that's
I
an
mean,
interesting
there's a
piece.
lot, and on a wider scale of that thinking, there's a lot of Americans relocating to Portugal now.
Hmm.
There are road shows being held in America talking about it. Yeah, so we've got new direct flights coming in. I'm in the Algarve in the south of Portugal. We've got new direct flights I think, from Newark to Faro now. So there's a huge interest there. And I think there's a few coming to the UK as well. So the travel part could be nice. And we could also even include, because one of the, what we do is wealth creation, but once you've created it, the problem becomes protecting it. So that's into tax planning, estate planning, residency planning, citizenship by investment programs. So we can also put people like that onto the agenda so that they could talk about, if you came to UK or Portugal, what are the tax considerations, what are the
Hmm.
residency considerations, and then it becomes a slightly more holistic thing because I know, depending on where you sit on the spectrum, some people are keen to leave America now, some people are very happy at what's going on there, but whichever
Hmm.
side of that divide you're on, coming to Europe and having a look at these opportunities from an investment perspective, but also adding a little bit about lifestyle, tax, etc., might be quite helpful for people.
Yeah, absolutely. And so that's a great thing. If anyone's out there who's interested in maybe exploring a partnership, I'm happy to make connections for you, to Graham and Nick. And I think this is an area that we'll see kind of an increase in interest, and it's a higher price, higher niche, or higher value part of the market. Again, it's not like we're going for 50,000 customers here. It's that like very premium side of the market,
Mm.
which I think there's a lot of room to grow in right now, and that's very attractive, I think.
Yeah, yeah, and that's true. And I think I just saw the latest family office report from UBS in Switzerland, and they were saying that across all the family offices they survey, they're putting 22% of their total assets into private equity now. So when you think how well informed they are, I think that does reinforce how important a part of anyone's portfolio this should be. And yeah, finding the right opportunities obviously is key, but also I think being part of the right community. And I think a publishing company is very good at building that kind of long-term relationship with its subscribers. It's a relationship of trust, and I think at the end of the day, any investment decision is based on trust. And I think because they would already have built that relationship, and then they introduce Inside Investor Club to that as a further trusted component, I think that plus meeting together, in live events could create a really strong bond between the subscribers, the publisher, and the club.
Yeah, no, I think that's great. I think the idea of like maybe co-hosted events and things like that makes a lot of sense, especially as an entry point for people who are interested in exploring it. So, like I said, I'm happy to make these connections for anybody. There's some people I can think of right now that I'd like to talk to specifically about this to kind of connect you guys with. But I'll put this out there for everybody to see and see what kind of interest we have coming back. And I really appreciate you guys coming and talking about this because it's a very interesting part of the market to me. And I do think it's one of those, like I said, one of those areas in the market that I think there's a lot of room for growth. So super interesting what you guys are doing.
Right. Well, it's
All
great
right,
to have a
thank
chance
you.
to talk about it. Yes. And thanks for the introduction, Nick.
Thank you, John, as well. And I think Graham's covered most of the bases there. And yeah, I think there's
Yeah.
some very interesting things we can do. Just thinking back to your FMS conference in September 2019 and all the great guys I met there, a lot from the States, obviously you and lots of others as well. I think something like a Lisbon event or a London event really could work well on all sorts of
Yeah,
levels.
well, that was probably one of the hardest things that COVID did to me was it killed my London conference uh for FMS, and it's definitely something that I've looked to thought very hard about bringing back in either actually Lisbon or London. So that's definitely something to talk about. But thank you very much, guys. This has been great. I will get this out to everybody, and like I said, anybody who has any interest in kind of having a conversation, just let me know.
Great
Thank you very
stuff. Thanks
much,
very
John.
much. Appreciate it, John. Thank you.
Appreciate it. Thank you. Bye bye.